Hey everyone, welcome back to The Explainer. Now, if you've been hanging around our community for a bit, you know we've got incredibly high retention on our past technical breakdowns of NVIDIA and the broader AI landscape. Why? Because we follow the data, not the hype. And today we are unpacking a really profound structural transformation happening right now in the global semiconductor space. We are literally shifting from a sector that was defined by cyclical consumer electronics, things like smartphones and gaming consoles, to one that's completely anchored by heavy-duty AI infrastructure. But here's the thing, the narrative is changing right beneath our feet. The initial phase of this AI boom, it was all about this insatiable, singular appetite for GPUs. But now we've entered a second, much more nuanced phase. We're calling it the middle manager era. Today, we're going to unpack exactly how the technical bottleneck in AI has quietly but decisively shifted away from the raw computational muscle of the GPU and moved right toward the orchestration and delegation mind of the CPU.
To really wrap your head around the sheer scale of this shift, just consider this absolutely brutal macro statistic. Back in October of 2022, semiconductor stocks made up just about 6% of the S&P 500's total market cap. Today, they absolutely dominate at a staggering 22%. I mean, really think about that for a second. The Philly Semiconductor Index, the SOX, is carrying an unprecedented amount of weight right now. The health of the entire broader equity market is basically tied to this single industry's ability to keep delivering on hypergrowth expectations. It's a concentration of wealth and focus that we rarely ever see. Which means, honestly, if you've got money sitting in a standard index fund right now, well, your portfolio is basically a semiconductor portfolio.
Okay, let's dive into this, because there is a massive mispricing happening right in front of us. While everyone else was out there chasing those legendary 100x gains on GPUs, the absolute most critical piece of the AI puzzle just quietly saw a 100 to 150% year-to-date rally. And spoiler alert, it's not NVIDIA. Retail capital is just aggressively pouring into this GPU-centric narrative, completely missing the fact that the high-performance server CPU is quietly becoming the most constrained resource in the entire data center. The market is evolving super fast, and the big winners of tomorrow, they're not just going to be the exact same ones who dominated yesterday.
So here's our roadmap for today's explainer. 1. The middle manager alpha. 2. Agentic AI changes the math. 3. The non-NVIDIA hardware winners. 4. Semis dominate the index. And finally, number 5, the brutal momentum trap.
All right, diving right into section 1, the middle manager alpha and the shift in AI hardware.
For years, the only thing anyone seemed to care about was raw compute power, the GPU. But as artificial intelligence is maturing, the really heavy lifting is actually moving to the system that orchestrates that power. So, phase 1 was all about generative chatbots, right? You type a prompt, it answers. That requires massive parallel processing, which is perfect for the thousands of specialized cores inside a GPU doing dense linear algebra. Think of the GPU as an assembly line worker who can somehow paint 1,000 car doors all at the exact same time. Super efficient at one highly specific task. But phase 2? Phase 2 is agentic AI, and this is fundamentally different. Agentic AI operates through these long-running loops. It calls external APIs, it queries private databases, it manages complex state. These are complex, branching logic tasks, and they are entirely bound to the CPU. The CPU is the factory foreman. The foreman has to actually decide which cars need painting, order the right colors, schedule the workers, deal with emergencies. The assembly line worker just can't do that.
Moving on to section 2, agentic AI changes the math and what we call the orchestration bottleneck. Let's actually define what agentic AI is and look under the hood at the mechanics, because we're facing what engineers are calling the orchestration bottleneck. Agentic AI systems are basically autonomous frameworks that can reason, plan, and execute multi-step workflows. Let's make this real for a second. Imagine you ask an AI to book a business trip for you. It's not just spitting out text anymore. It actually has to check your calendar, cross-reference live flight databases, securely input your credit card info, and then maybe generate an expense report. In that setup, the GPU is really just a numerical accelerator. The CPU is the head node. It's the middle manager. It's the CPU that's handling the tokenization, assembling the prompts, enforcing the safety policies so the AI doesn't just hallucinate or do something illegal, and it's doing all the routing and memory access. And as these autonomous systems scale up to handle millions of real-world tasks, they demand an absolutely massive amount of CPU concurrency.
And when you look at where the time is actually being spent in a modern AI data center, it's pretty wild. The numerical tensor operations, so the actual math being handled by the GPU, that only accounts for about 10 to 50% of the latency in these complex workflows right now. But the planning, the orchestration, the API calls, all the stuff handled by the CPU, that is eating up 50 to 90% of the total latency. So we've got this massive, glaring workload mismatch, and it's creating an honestly kind of ridiculous situation in server racks today, where you have these incredibly expensive state-of-the-art GPU clusters literally just sitting idle, just twiddling their silicon thumbs, waiting for a standard server CPU to process the logic and direct the traffic.
This mismatch is fundamentally altering the physical hardware that needs to be deployed, and obviously the capital expenditure required to do it. Historically, data centers would install one CPU for every 4 or even 8 GPUs. But because of this new orchestration bottleneck, hyperscalers, we're talking Amazon, Microsoft, Google, they are being forced to drastically rebalance their infrastructure. We are moving incredibly fast toward a 1-to-1 ratio. Going from one CPU for every 8 GPUs to a 1-to-1 match, that is a massive CapEx shift. We're talking billions of dollars being completely reallocated. In fact, AMD's leadership recently pointed out that as tasks delegate to multiple agents, we might actually see compute nodes with more CPUs than GPUs. This shift is driving a huge supply crunch and giving incredible pricing power to the top CPU makers.
Which brings us to Section 3, the non-NVIDIA hardware winners and seizing the control plane. Now that we've established the technical reality here, let's talk about who is actually capitalizing on this. Advanced Micro Devices, AMD, has really emerged as a primary beneficiary. By late 2025, they surpassed a 40% server CPU revenue share for the first time ever, hitting 41.3% against the rest of the market. And this exact shift is exactly why we've seen AMD's stocks surging 17 to 18% recently. It is being driven specifically by this explosive CPU demand, not just their GPUs. Their high core count EPYC processors are just winning the premium sockets right now. Because in agentic systems, software friction actually matters way more than peak efficiency. AMD's x86 architecture has this thing we call software gravity. Basically, that means it integrates seamlessly with the millions of lines of legacy enterprise code that these huge companies already rely on. So every single time a new GPU gets added to an AI factory, it just increases the desperate need for AMD's orchestration engines. Then you've got Intel. They have staged an absolutely incredible 150% year-to-date turnaround moving into 2026. I mean, their Q1 report was just a total blowout. They crushed consensus estimates across the board, and their foundry segment was up 16% year over year. But the real fundamental catalyst going forward, it's Edge AI. And if you're not familiar, Edge AI basically just means bringing the artificial intelligence processing out of the remote cloud and pulling it directly onto your local laptop or workstation. As AI agents move closer to the user, to cut down on latency and boost privacy, the demand for power-efficient, highly capable CPUs that can run inference locally just absolutely skyrockets. It effectively lets users completely sidestep the cloud for their everyday AI tasks.
And the sheer volume of this hardware shift is just staggering. Look at ARM Holdings. They are transitioning from just licensing architectures to actually designing chips, and they just launched their own AGI CPU. ARM is projecting that solving this orchestration bottleneck is going to drive a 4x increase in CPU core demand. 4 times! We are talking about jumping from 30 million up to 120 million cores per gigawatt of power. To put that physically into perspective for a second, entire warehouses of servers are literally being retrofitted right now just to house these additional orchestration cores. It's wild. Demand for ARM's platform doubled in just 6 weeks because these tech giants are just absolutely desperate to solve this 90% latency issue.
All right, Section 4. Semis dominate the index. Looking at the pipes of the middle manager.
You really can't talk about CPUs and GPUs without talking about the connectivity layer. Think of it this way. If CPUs and GPUs are the brains of artificial intelligence, companies like Marvell Technology and Broadcom are the vital, high-speed nervous system linking it all together. Because if the brain cells can't talk to each other instantly, the entire system falls apart. Marvell is sort of the high-growth architect here. They completely dominate the 800G optical digital signal processor market with like a 70 to 80% share. They are the ultimate picks and shovels play for custom chips, but they are currently trading at a pretty steep 56 times forward PE. Broadcom, on the other hand, is more of your safer blue-chip giant. They command a massive 70% share in custom AI accelerators, they boast profit margins over 77%, and they trade at a much lower forward PE of under 30. But both of them, they are raking in absolute billions right now just by providing the necessary pipes for our middle manager.
This brings us to our final section, Section 5, the brutal momentum trap, where we weigh technicals versus fundamentals.
Okay, so this is where we need to execute a bit of a turn. The fundamental story of the middle manager is undeniably strong, yes, but the technical reality of the market right now, it's a brutal truth that you simply cannot ignore. By May 2026, many of these semiconductor leaders are trading at prices roughly 56% above their 200-day moving averages. This kind of technical extension is literally the textbook hallmark of a momentum-driven rally. Buying in at a 56% premium to the long-term average is a classic psychological trap for retail investors suffering from major FOMO. You know, people buy in right at the absolute peak, just assuming that this hypergrowth will somehow continue uninterrupted forever, rather than actually looking for real fundamental value.
Just look at how far these specific stocks are stretched right now from their 200-day moving average. Intel is extended by 63%, AMD is up 52%, but meanwhile, only 55% of the overall S&P 500 constituents are actually trading above their 200-day moving average. So the market breadth is alarmingly thin. What this really means is that the AI trait is practically carrying the entire index on its back. If this AI narrative falters even slightly, the entire S&P 500 is going to feel the shockwave. Retail money is just aggressively buying this general AI theme right now, and they are paying a massive and frankly dangerous premium for past performance.
And here is the ultimate brutal irony of this entire rally. Let's look at the valuation matrix, specifically the PEG ratio, which is price to earnings to growth. It basically factors in how fast a company is actually growing. NVIDIA, the company that literally everyone assumes is just massively, insanely overpriced, sits at a 0.65 PEG ratio. Yes, NVIDIA's stock price went up, obviously, but their actual earnings exploded so fast that the stock essentially experienced multiple compression. Mathematically, it actually became fundamentally cheaper relative to its massive growth. It's currently consolidated to just 8% above its moving average. Meanwhile, look at the challengers. AMD is sitting with a 1.26 PEG, and ARM is trading at over 300 times trailing earnings. They are incredibly expensive. So paradoxically, NVIDIA mathematically offers far more downside protection right now than these high-flying CPU stocks.
So let's tie this all together. The transition from generative chatbots to autonomous AI agents, that is a structural reality. The fundamental bottleneck has definitively shifted away from the GPU to the CPU, our middle manager. And yes, the pure fundamental alpha lies in identifying this non-NVIDIA hardware stack. But as an investor, you absolutely must separate the fundamental reality of the technology from the technical bubble happening in the stock market. Because at the end of the day, the price you pay to enter that trade will absolutely dictate your eventual return.
I'm going to leave you with this final thought to help you critically evaluate your own portfolio positioning right now. Ask yourself, are you genuinely buying fundamental alpha, or are you just falling for a technical momentum trap? The next stage of this AI trade belongs to whoever owns the most efficient orchestration of the chips, not just the chips themselves. Thanks so much for joining us for this explainer. Stay focused out there and keep asking the right questions. We'll see you next time.